Aloha. On this Tuesday, August 18th, we welcome you to the Investing Master Series. I'm wearing my Hawaii shirt. Now we know why Scott's always in a good mood. And we welcome all of you. Here today, we got with us Wylan, Will, Kevin, Grace, Billy, Michael, BJ, Rojo, Cherker, Gary, and many others. Welcome and good morning to all. We also have with us in the chat Barbara Armstrong. She's our resident expert, and we welcome her as well. So, yes, Canadian flag. We see the maple leaves. They're pouring in already. All right, a little fun there. So, just real quick as we get started, want to give us a quick reminder that with what we discuss here today, we're going to talk really about stocks and options. And as we do those, we'll do those examples in the paper money account. And we want to kind of talk about some past trades, which we need to, but we're also going to talk about some new trades as well. My focus really here today is kind of one of the questions. I had a barbecue over the weekend. 100 adults showed up in my backyard and they were asking about investing. Okay. And the question I got a lot is, how do you invest? And I want to kind of talk about that theme of what is the process of really investing? What is it that you're really doing? How do you do it? And so that's my focus here today. So just real quick as we hop right in, remember that Barbara and myself, we do post educational content on X. There's my handle at James Boyd CS. You could find you could find some examples of things that we talk about in class, but also announcements as well. Join us there. Barbara will post her link in the chat. That way you can click on it and follow her as well. Now, remember, when we talk about stocks, we will also talk about options. Remember that options carry a high level of risk and are not suitable for all investors. When we talk about the information, it's done for general informational purposes only. When we talk about examples, we will do those on the Paper Money software application. When I got started, right after the Vietnam War, at least it seemed close to that, we didn't have paper money. Never heard of paper money. Didn't have any software. It was all web-based, okay? We are just absolutely, well, we're lucky, okay, to have something we could test ideas or test trading symbols on, and it's paper. Okay. When I got started, it was 100% real money. Never heard of paper money until about 7 years after I got started. Okay. Now, so here I am. Now, remember that also investing involves risk. Without risk, there's no reward. So we have to kind of understand, what is that risk? And is that something you would consider? Now, also remember, when we talk about examples, we might bring up short options like cash secured puts, example given. Those type of strategies can be assigned, which means you're the buyer of the shares at the strike price, irregardless if it's in the money or not. They're American style options, so they're a pending obligation. Okay. And is that okay? So if you sell a put, you have a full understanding. Just because it's not expiration doesn't mean you can't be the buyer of the shares at the strike price. However, you still get all the premium. Okay. So it might not always be bad. Okay. But just that's the risk. Now, also, when we talk about examples, we're going to talk about today stocks and option examples. I want to kind of talk about some of the sentiment that we're seeing in the market, at least today. So remember, we talked about the theme of like, what is it that we really do when we're trading and investing? Okay, I want to kind of walk us through some of the things I like to look at and why we look at those. So first off, I'm just going to pull up the Dow Jones. Okay, we don't have to start at one versus the other, but we're for sure going to look at the four. Okay. So when we look at, let's say, the Dow Jones itself, I am looking at to see where's the price in relationship to the moving average. We are still falling down, at least on the Dow. So that means if I go look at Dow stocks, we're probably going to see more stocks than not that are falling down. Why do we actually look at the Dow Jones? Because we're looking at large caps. Okay. Not all stocks are the same, of course. When we also say large caps, we're also saying these international blue chip companies. Not all, though. So when you see the Dow Jones going down like this does not mean that all are going down, but probably the majority are dropping down. Now, if you take a look at, let's say, is it really falling apart? Not necessarily. The old breakout was right around the 530-ish area. If we're going to get a bounce and we're going to actually kind of hold this trend, we need to stay above that 530 threshold. So kind of where we are in the shorter term pullback in that intermediate upward trend. Okay, there she is. Now, if we go to the S&P 500, which some might start here, we look at, let's say, the S&P 500 and the old breakout area was, let's say, 7,600-ish. we fell down this morning on the S&P 500. So remember, the S&P 500 is top heavy technology. Technology dropping this morning, okay? And you see the price dropping down there. So don't like that, okay? So shorter term, negative momentum, price below the short-term moving average. We just recently, 3 days ago, made a brand new high, but kind of in that process of making the flag. Same as the Dow. It's not lights out bear market, but it's just in that pullback phase. Now, if we go back to, let's say, the NASDAQ itself, there's the culprit, right? And if you look at that, it kind of was getting closer to that 30,665, fell down this morning, down 1.78%. If we look at the SOX just real quick, the culprit, SOX here today, dropping down 5.77. We need to talk about a couple of those and talk about stops, okay, on a couple of those positions. We'll bring that up, and that's not helping. Now, the funny thing is, if you actually look at, let's say, the tech, you did see cybersecurity up today. You saw cloud up today. It's not all tech, okay, but you are seeing semis down this morning. Now, you got to remember something. The semis have been up high percent. They go down high percent. This is the big boy, big girl game, okay? SanDisk can go up 100. It could go down 100, okay? So you just got to realize that if you're not one for volatility, the semiconductors are probably not the one you're going to be looking at. Now, the Russell 2000, the small cap companies, those even dropped here today. Old breakout level, probably right around 30, 13. So if we kind of summed it up, we would say everything kind of looks like, as of this morning, a little flag in the upward trending market. Now, let's go back to kind of the volatility. We would expect the volatility might tick up a little bit. It did. Did it crash higher? I'm not sure if I'd say it crashed higher. Okay, now, if we see the VIX goes up, what's the meaning of that in terms of managing a portfolio? Well, might start to get stomped out of some positions. Might start to maybe consider applying some protection on some positions that are higher beta. Why? Because those are the ones on a percentage basis that are probably going to drop more. And the other thing is, it might cause maybe some investors to rotate from those higher growth areas to some of those more value to income areas. And when we say income areas, we're talking about the healthcare, staples, real estate, and utilities. It's not that they're not investing, they just might change in what they're investing in. Now, that crude oil, which has been just sticky, you're going to see that now, if you look at crude oil, it kind of looks like it maybe has what type of potential price pattern. Now, we got Barbara Armstrong with us. Do not leave her hanging. She's going to feel like maybe her teaching was in vain. I don't think it is, because I'm the chat person. I know it's actually sunk in. Is there any type of potential price pattern that we're starting to see on crude oil? Yeah, on crude oil itself, if we pull this back up, crude oil is kind of like, you kind of have like a little drop down, right? There, and there. So you could even say that maybe there is an inverse head and shoulders. It doesn't always have to be like this, okay? It could also be diagonal in nature. That's a horizontal inverse head and shoulders. And this is more the crude oil, the diagonal version of that. So, I mean, if we broke above, let's say 84 and we went to 93, it wouldn't be surprising. Now, we'll come to some of those names in just a moment. Now, here's the thing. If the investor said, James, in my portfolio, I have tech stocks. Let's say in your portfolio, you have maybe 12 stocks or 12 positions in total. And you told me that you had 8 or 10 that were in technology. Well, example given in today's, like today, you feel more the brunt of that. Whereas if you said, look, I have maybe 5 or 6 technology and I have 5 or 6 that are in income and value, the technology does move the portfolio, but it doesn't move it as much. That's the point of having more a balanced, offensive approach where your portfolio is not just top-heavy technology. It's easy to do, especially when the tech is going up. Now, if we go back and look at the rates, these rates, the 10-year rate, did tick up to about 4.75 today. You got to remember something is this also kind of creates a potential opportunity. Some people might say, I mean, this is Investing Master Series, right? So not everything in investing is stocks. Some people might want to say, James, I want some of my money in cash. And with those rates going higher, that also might kind of tell us something. Maybe investor park some cash or a fixed income type of product and get a higher potential return. Okay. Now, is this also kind of telling us the economy is growing more? 2, is there maybe more risk in the economy? 3, is there also more inflation? I think we believe that latter. Okay. So if we take a look at this, 4.72. Now remember, this affects the higher the interest rates, the lower the valuations on stocks. And the last one to really bring up here is the US dollar before we look at examples. The US dollar kind of on bended knee here, trying to hold the levels. So like other fiat currencies, right? If the US dollar goes down, some of those other currencies might appreciate in value. So if we said kind of like what's kind of the risk we're seeing here, crude oil looks like imminent that it might even try to go higher, like $10 higher. Okay, keep an eye on that. We'll bring up the sector in just a second. VIX, could it go up a little bit? It shows maybe some risk of appreciating a little bit more. Yes, rates are already up, dollars down. 3 out of the 4 kind of showing a little bit more of a kind of a bullish tone on those sentiment gauges, which sometimes can be pullback-ish for markets. Now, I'm not saying bear market, but you can have pullbacks in upward trends. Now, when we talk about the sectors briefly, remember I kind of talked about if you get, let's say, technology and discretionary going down, it's not that people don't invest, they just might change what they're investing in. Now, when you see this, what's the first thing that comes through your mind? Johnson & Johnson. No, even though that might be option number 2. Okay, what's the first thing that goes through your mind? Don't leave me hanging here. The first thing when you see this, what goes through your mind here? Yeah, so when you see this, option number 1, the investor might say, instead of buying maybe the individual stocks in that space, the investor might say, I'm just going to consider buying the space of healthcare. Now, Brent Morris actually teaches ETFs on Monday afternoon. Kevin and I teach it on Friday morning. Option number 1 is just buying the group, considering it. Option number 2 is what stocks are in that group. Okay, now, today's not ETF day, but that's option number 1 to consider. Option number 2 is what stocks are in that space that might be appreciating. Now, let's just kind of hit some just real quick. So remember when we talked about the Dow Jones, right? We talked about that. And remember when we actually look at, let's say, the Dow Jones on the left-hand side, there's Johnson & Johnson. Oh, wow, number 2. Now, if we did our due diligence and all, we did our routine, and this is, remember, what we're focusing on is how do we invest? Well, when we kind of walk through this step progression, just click on it. I don't need to run a search for what? Why do I need to run a search? Why not just actually look at, let's say, the index list itself? Isn't that a list? Now, if you look at Johnson & Johnson, is that a bounce? Is it a breakout? We could also hear the question, well, it's already too high. We missed the run. Missed the run. Yesterday at the close of the first day, today at the open, we're only 90 minutes into the open. This is the first time we've seen it. Okay? So too late. Too late. We wouldn't think it's too late. Now, we might double check and say, where are we in the percentage? We're barely at the yellow line. So do not, well, if I was talking to myself, what would I tell myself? James, do not be lazy. Go look at the moving average envelopes, James, and see where we are. We're barely at the 3%. Let's come back to that in just a moment. Now, when we look at some of these other, let's say, healthcare names, Amgen's been grinding. Lilly, which is in the chat, okay? Lilly is also one, it's a higher price one, but it's kind of building some higher lows. Keep an eye on that. Bigger dollar price. Abby V, my daughter's name Abby. Okay, so this one's kind of I don't know, kind of think about it. But if we look at, let's say, AbbVie, little rotation, Merck has probably been the one that's been a grinder to the upside. Now, here's the thing. We complain that the stock moves too much, at least when it goes down, not when it goes up. But then we actually say stocks like this, they're just too slow. Well, what's wrong with some of the ones that are just grinders to the upside? Okay, they have less volatility, or have historically had less volatility, but they just grind out a trend. Okay, Medtronics is also another one in there that's actually shown a reversal. BMY, Lisa Jack's favorite. Okay, Bristol Myers Squibb, a little bounce there. And probably another one that we need to make mention of is a little Gilead Sciences. Okay, Pia also mentions Bib. Okay, so a couple in there. Now, I want to go back to just real quick. I want to look at one. Okay, I want to go back to, let me see something real quick. If someone said, James, I like kind of more reversal candidates, they might say Gilead, okay, where it's base, had a horizontal resistance, and is starting to break out. If someone said, James, I kind of like those that have had a little consolidation, maybe an ascending triangle like, and they're starting to kind of show they've had higher lows, okay, right there, and it's starting to kind of break to the upside. Okay, now, what I want to do here, just first off, I want to imagine that we said, now here's kind of the interesting thing about options. With options, it's not dollar for dollar movement on many strategies. If we decided, you know what, I want to sell a put on Johnson & Johnson where the delta is not 1, it might be delta 30 to 40 to start with. And I don't know exactly if it's going to shoot up, if it's going to go slightly up. I don't know if it's going to go flat. I don't know if it's going to go slightly down or down. I just think the bias is upward. I don't know. It just stay up above a certain strike price. And when it goes up and down, up and down, up and down, I don't want the movement to be a dollar for dollar, meaning stock goes $1, the option moves $1. Now, in trade example number 1, what I want to do here, and by the way, I do want to get to a number of trades here today because there's some interesting things to look at. Trade example number 1 is I want to go to Johnson & Johnson for just a second. And what I want to do is I want to sell in this example. We're going to go look at, let's say, the delta of, let's say, 260. Now, we're looking at the September 260. And then what we're going to do is we're going to buy the 240. Now, remember, this is not your typical vertical spread where it's $2.50, $5, $10 wide. It's $20 wide. This position, we would really classify it as it's really a cash secured put with downside protection. Why did you just jump to the conclusion of the 240? Because my eyes were looking at which strike has a delta of 10 or less. We don't ever think that delta of 10 or less is probably going to be worth something. Very low statistical chance. But what we're trying to do is make it where we could have a risk where it's not all the way down to 0 on the stock price. The con about that is, well, you got to pay for it. The con about that is it lowers your credit. The con about that is it increases your break even. Okay? Now, so we have a built-in max profit given this wider spread. Number 2, there's a max loss built in. If we did not buy the put for about 40-ish cents, we would be taking a risk of about $26,000. Many people might want to say, or they might say, I think I'll buy the put. That's the whole point, okay? The point is to take that risk off the table, that it could go all the way down to 0. Remember, if you sell a put, you're the buyer at the strike. If you buy a put, you're a seller at that strike price. So sell the put, buyer. Buy the put, you're really a seller at that price. Buy at the strike that you sell at the strike that you bought, okay? And there's the numbers. Now, the other thing is 65 cents for the commission. Some people might even say that's negligible considering that it takes off the risk, okay? That's up for you to decide, but that's how maybe someone might come to review that, okay? And say, is that worth it? Now, trade number one, Johnson & Johnson. Okay. Now, when we also do this, I want to make sure that it's going to be a positive delta trade, meaning it's a bullish trade. Second, it's positive theta. The one thing that we don't know as bullish investors, we do not know from day to day if each day it's going to go up. The one thing that's probably more constant than not is the time decay. And this is where it goes back to. We could buy stocks. We could buy some things like we do on Friday. But the biggest thing is we'd like to maybe consider having some time decay in the portfolio. Now, does that mean someone has to do that? No. But this portfolio, we're going to try to always have some positive time decay, whether it comes from short put verticals, cash secured puts, covered calls, something where it's actually positive time decay. So if we looked at this portfolio and said, well, does it? Well, if we looked at this portfolio has a theta of 108. Now, let's assume that we held these positions for the next, 20, 30 days, 30 days. Well, it would be about $3,000-ish a time decay, assuming that the theta did not change. Technically, the theta should increase as those actually trades get closer and closer, or as those trades get closer and closer to expiration. So we have positive delta, which tells us this portfolio is bullish. Theta is actually positive, and you're going to see negative vega. If you sold cover calls, short put verticals, cash secured puts, what you're going to see in this is we should have negative vega, meaning if volatility expanded, it makes those options more expensive to buy back. That's the nature of it, okay? Now, what I'm going to do is, so trade number one was Johnson & Johnson. Any questions on this so far? Okay. Now, if we take a look at this, yeah, that's funny. Comment was JB likes to buy at resistance. Well, so here's the deal. You could look at it like that, okay? Or you could say that JB likes to show examples of buying stocks that are bouncing off diagonal support. If they have diagonal support, that means they have higher lows. If you make higher lows, the greatest likelihood is that resistance that we think is so strong probably does not hold. And especially as JB likes to show the examples of buying bullish stocks in bullish sectors. All right. So that's where we start to kind of think that maybe that resistance might not hold. Okay. So the higher lows, the upward trend. Okay. And also a bullish sector. The other thing about this is when usually healthcare, utilities, staples, real estate tend to do the best, it's when the VIX is lower and maybe starting to increase a little bit. So that's why we kind of said last week, if staples goes down, does the investor want to sell it? We said no, because usually if the VIX is low, that's usually when those areas might do potentially the best. Okay. Now, let's also go back to one other one just real quick. Now, you're going to see that also in this list was Coca-Cola, okay? Now, the reason why we're talking about Coca-Cola is that is in the paper money portfolio. It's Dean that has kind of talked us through that. Now, if we go to the monitor tab for just a second, where is it? Coca-Cola right there. Is it shares? Is it options? What is it? It's shares. Now, if we look at this, it's up $500. Now, 100 shares of a stock that was 83, we had to put out $8,380. Now, last week in our class, we talked about, and I'll bring that up, we talked about the concept of long calls versus long synthetics. A lot of times when people see these kind of staplish type names, they think to themselves, a lot of times, and I used to think this too, I wouldn't buy that because it's too expensive, okay? If I had bought any shares at all, it just wouldn't be worth it. Well, who says you had to buy the shares, okay? Now, what we're going to do is going to go back to the trade tab. Now, when you look at this, and I'm going to kind of flatten it out a little bit, flatten it out meaning we're going to go from a candlestick chart to where it just kind of takes out some of the noise. So when I say take out some of the noise, I'm just kind of talking about these green and then red candles, green and the red candles. We're going to kind of take those out a little bit, okay? And now what you're going to kind of see is less. When we get green, it goes green. When we get red, it goes red, right? So if you look at this, you're going to now notice that we're talking about just very simplistic. We're looking for an upward trend, okay? Now, I think sometimes as investors, we complicate it, okay? If we looked at a 1-year daily chart and we started last year at the bottom left and we are over here on the top right, that is an upward trend. Now, when we see the price goes up, we think it's overvalued. But wonder if I told you that revenue was up 15% year over year. Wonder if I told you that the dividend was actually up 20% year over year. Wonder if I actually told you that the earnings per share were up 30% year over year. You don't even factor that in because all you're looking at is the price. The price does not tell you everything, okay? So if we take a look at this, we're going to go back and we're going to zoom in on this. Now, if we kind of said what type of, we know the trend's up. We now want to kind of see support. When my mind thinks support, I'm thinking about the last 2 to 3 weeks, okay? Now, why not the last week? Well, that's only 5 days, okay? I want to try to get a little bit more time than just the last 5 days. If we pull this up and say, if I were to draw support, horizontal or diagonal over the last, let's say, 2 weeks, where do we see some support levels? It's probably right around about 86.5, okay? Now, if we take a look at this Coca-Cola, A, buy shares. We already have shares. Option number 2, buy the call. Now, remember, buying the call is the right to buy the shares at the strike price. Let me just show you this just real quick. I think we kind of need to just walk through like what does it mean and how does it work. So if we bought, let's say the stock's at 88.80 and we came in and said, look, I'm going to buy the 87.5 or 270 and we just bought that. Okay. Now I'll try to buy it at maybe 265 or so, a little bit higher. So we try to get a fill. If we did this and if it got filled, there it is. We now have a right to buy the shares at the strike price from now until expiration. Now, what are we really trying to do? Well, we're trying to get the stock to go up that influences the option value. Okay? That's what we're trying to get. So if we said, look, I really don't want the shares, I just want the stock to go up, so it actually pumps up the intrinsic value and makes the option more valuable. And I could sell that option or try to. Now, let's say we decided, you know what? I don't want to just trade the option value. Coca-Cola just bought Pepsi, hypothetically. And now it's going to turn into, a monopoly and they're going to grow and grow and grow, whatever. And you decide, I don't want those shares anymore. I want to exercise my right to buy the shares at the strike price. How do you do it? Right click on that line and say exercise. What do you exercise? Are we talking about exercise like get on the bike and the treadmill? No, we're not talking about that, even though that's important. Now, if we right click on that, you're now going to see if I right click and say exercise, what is it going to do? You're getting rid of the call that you have on that first row, and you're buying the what? The shares. Where are you buying the shares? At the strike price. Who controls that? You do. Me. In this paper money trade example. Now, so let's say example given, look, let's say, okay, fine. We already have the shares, but if I want to exercise, I showed you that. But let's say, nah, James, I just want to actually trade Coca-Cola because I think it could go up to what price? Well, if we said, look, I think Coca-Cola could go up to what price? Now, what I'm going to do is I'm going to go from kind of the top of this candle. Where do we go up to? James, body to body Boyd. I don't like to take outliers of data sets. I like to take where we actually have more of the population of the data set. If you said, I'm going to draw from here all the way down, you're taking the extreme points of the data being the price. I don't like that, okay? So what we're going to do is we're going to draw from here, drawing it down to where do we start from? The body. Now, I drew it from the high, the body of the candle, down to the low, the body of the candle. Why? Well, because we're trying to say, look, if we can get above that 89.35, it's going to give us that 161 extension above us and also the 200% extension. So what I'm going to do is we're now going to use that. I'm going to go back to this order just real quick. And we're going to say, look, if you can go to $94, sell the call. How do you do that after you already put it in? You can go to the trade tab, right click on it, create closing order. That's not too bad. Right click on it, get a menu, create closing order, and say sell that call. Now sell the call when? We're going to sell the call limit to a market. The sale of the call is going to be conditional upon the stock going up to a potential price of $94. So this will be market dated GTC. Click on the gear. And now if we slide this over, we're going to say, look, if Coca-Cola gets marked greater or equal to, now notice that V is pointed towards Coca-Cola, meaning Coca-Cola is greater, the stock price is greater than or equal to $94. If you get confused by that notation there, don't worry. We've kind of wrote it down for James Boyd here so he can understand, and it will read out, we're looking for the stock to be 90, the security is greater or equal to $94. So if you get confused by that notation there, just know that it's going to show that in writing here. Okay, we should feel better. Save, confirm, and send. Now, if you buy the call, what did it do to your position? Well, if you have 100 shares and you buy a call, buying a call is a bullish strategy. A bullish strategy, positive delta. What does the number 63 means? It means if it's the translation, approximately if the stock goes up $1, the option which should be, could be up about $62. If the stock went up $1. The stock went down $1, the position would be down about $63. Now, or 63 cents in other words. That doesn't sound like a whole lot until you realize that you didn't put in $8,000. You only put in $261. So if we got a 63-cent move on an option in which we spent $260 on, $1 move up or $1 move down is moving, it's the rate of return is 24%. So if we got a 63-cent move up or 63-cent move down on something that we spent $260 on, that's 24%. That's leverage. Okay? All right, now the question came from Pia. Pia says, when one draws fibs on Heikin-Ashi candles versus regular candles, do targets change on the 161 extensions? Curious. Huh? Okay, yeah, let's go look at that. So you would expect that those probably would change a little bit. Let's go back to this for a second. Let's see. Let's send that. And now what I'm going to do is I'm going to go back to, let's take this drawing off. Let's leave it for a second, okay? Let's go back to this candle. So there it is. Now, what's interesting is, notice where the 100% is. The 100% is not much different than the regular candle body. I mean, we're talking about 20 cents. And if we look down there, I drew it down to the bottom. I drew it down to there at 81.39. And if I redrew it, we would be, it's 20 cents off the closing high and that body of the candle that I'm pointing to. It's closer than you would think. Okay? All right, now, Silas, how are you doing? Now, let's go back to this just real quick. Roku says, would you only do this on very liquid options and narrow spreads? Holy Toledo. Very good point, okay? Here's the thing. If you do a condition, so on any option trades, you're trying to look for trades that have a spread narrower than 20 cents. Now, this actually has a spread of 8 cents, 3 cents, etc. You got to remember something. The liquidity now is not the liquidity in an hour, 2 days from now, okay, 2 weeks from now. but we're always trying to stay in the pool where the stock has millions of shares traded daily. That way, it probably increases the chances that the spreads are tighter on the options. But we have to understand something. If the VIX all of a sudden went up to 40 or 50, you could have something that trades more shares of stock, but in a more volatile market, and if we use volatility like VIX, the spreads on the options will typically widen. Okay. So as an investor, you're saying, what market conditions are we in? If the VIX now is at 50, am I expecting the spreads to be tight? No, just not. Okay. Now let's also go. Now, what I want to do is let's also take a look at some others. Now, one of the ones that has it's just been boo, Apple. Okay. Now, if I go back to just real quick on Apple, okay, Apple, it's shown signs. It really, if you go back about a week ago, it had a breakout of the horizontal line. Now, this has never happened to you, but it's happened to me. Okay. And if we take a look at this, it even showed a time where the stock got above that resistance. And on that day, you thought, hey, maybe we're reversing that trend. Okay. Now, if the investors said, James, I want to see these MACDs rotating to the upside, maybe even going green. Now, you got to remember something. Well, for some Apple users, the September release is upcoming. You could Google that. When is Apple's new product release? Find out when that date is. If anyone knows that, go ahead. For some people, this might determine what is going to be on your Christmas stocking wish list for Santa Claus or your spouse. Now, the big actually thing is when you take a look at this, let's say the investor said, I would never buy this at resistance. You're out of your mind. So it also goes back to what type of strategy would you pick? Now, if we said buy a long call, as I just showed on that Coca-Cola, the long call is sensitive to the price movement. Long synthetic, even more sensitive to the price movement, bigger delta. But if the investor said, well, what's below that in our example? Well, maybe without buying shares, maybe like a diagonal spread. Set a third of that might be, let's say, a long call vertical. A little bit more price forgiving, short put vertical. Now, if we said, look, I want to kind of do a long call vertical. Let's just kind of go to this just real quick. It's going to start with where we ended on Coca-Cola. We're going to buy the at the money call or the in the money call. Now, technically, that's in the money. That's in the money. Why? It's shaded. When I say in the money, we're talking about where the strike is below the current stock price as of right now. So if we buy a call, let's say at 310, or I buy a call, let's say 305, and I'll choose something that has a little bit more intrinsic value, well, you're going to see it's at 305. That's 305, and the spread there is about 30 cents. So tighter spreads, that one's tighter, but I want something that has a little bit more intrinsic value. Why do we care? Well, anything that actually has a higher delta, greater chance to be in the money at expiration as of right now. And so what we're going to do is we're going to buy the 305. And if we buy the 305, what we're going to do is we're going to sell the call above. Now, let me show you something. If we did the 305, 310, okay, trade number one. If we did the 305, 315, which one is more conservative? Meaning, which one has a lower break even? Do you know the answer without looking? You should. Well, if you did the 305, 310, they're lower strikes. That has a debit of 285. Break even, you don't even need to pull it up. You know, just run the math in your head. 305 plus 285, we know the break even is 307.85. Where are we now? 310. So the stock could go down a little bit and still be above break even expiration. I'll pull that up. So if you say, James, I'm not there yet, 307.85. Now let's change this. Let's say you said, James, I'm a little bit more bullish, 305.315, and unlock that 525 debit. Well, now when we actually take a look at this, the break even is now not, let's say 307-ish and change, or whatever that number was. Let's actually go back and bring this up so we could compare 310. That break, it was 307.88. So 307.88, and we're comparing that to the break even here. 307.88 compared to a break even of 310.28. Now, if I said to you, man, my portfolio has been very volatile, I want to kind of do trades that are a little bit more forgiving, lower break evens, I wouldn't pick the 305 to 315. So you have to learn to adjust, right? If you're realizing as you're paper trading, I don't like the volatility, I don't like the how big the delta is, change the strategy, change the instrument. As we as people, we don't change until the very last blasted second. Nice thing to practice to paper money. Maybe the strategy you've been looking at, they're maybe not for you. Maybe the ticker symbols are too volatile. And I think that's probably 70% of it. So what we're gonna kind of play the role of, hey, I don't like volatility. I want something where there's a greater chance to be above the break-even expiration. So with that said, we're gonna pick the 305, 310. Now, with that, someone's now going to bring up the point, yeah, but I want to make more money. Look, at first, we're not trying to make the most amount of money. We're trying to become confident with the strategy, what, why, and how. And we're trying to say, can we get this stock to go up in our favor? If it does, max profit, max loss. There's the numbers. And now we see the commission right there. Now, so trade number one, what was it? What was trade example number one? Johnson & Johnson. Trade example number two, Coca-Cola. Trade example number three, Apple. Long call vertical. Send it. Now, just real quick, when is Apple's release date? Does anybody know that? Now, I just want to look at this, pulling it up myself. See if it's publicly out there. I just want it's early September. Okay, speculation, or at least posted on the internet, September 8th or 9th. Non-confirmed, okay, but that's what's out there, okay? That's on multiple places. Now, let's just say the first week, let's just say first week-ish of September. Well, we're kind of inside 3 weeks. Now, that early product release, you can kind of almost think of that as like an potential earnings release to some degree, okay? So we're inside that 3 weeks. We're going to look and see if maybe some investors start to speculate really on that. If we start to see more and more, let's say, liquidity, or I should say interest, that should actually be kind of showing multiple different. Now, this is kind of what's kind of interesting is keep an eye on the volume relative to the open interest. Keep an eye on that, okay? Now, other ones that I want to kind of just make mention of, when we take a look at a stock like Netflix, Pershing, I think it's Pershing Capital, check me on that. They took a stake in this. If we said which one might have a high chance of reversal with new institutional interest, it could be Netflix. If we had a little bit more time, keep an eye on that. We could do a trade on that. That's had it's 1, 2, 3, 4, 5 higher lows in a row. The first one is right on the moving average line. That's why you don't see it, okay? But if we said which one might have maybe a quick bullish reversal, Netflix. The other one that we might kind of say is if someone said, James, I want to practice some leverage in this type of environment where then maybe that VIX ticks up a little bit, AT&T. If we said of the AT&T of Verizon, You would probably say Verizon looks a little bit more bullish. These are ones that have lower betas, meaning they're correlated less historically to the market, but they also have the income from the dividend. Remember, dividends are not guaranteed in time. They could change the policy or the amount, etc. And the biggest actually thing is keep an eye also on Verizon. Now, I'm out of my time here today. Wanted to kind of walk us through some of these things that we would normally be looking at as we're trading and or investing. Clearly, we're kind of more bullish investors. Okay. We're looking for things that are actually going up and then picking some strategies that might be more suitable for some investors that are trying to just get exposure to that trend. You get to decide what you would consider for yourself. Go out and practice and pay your money. We got Cameron May coming up next with getting started with options. I want to say thank you so much for Barb in chat answering those questions. Do not forget, if you went to YouTube, you could go to Trader Talk Schwab Coaching Webcast. In the search field, it comes to this page. You could subscribe for free. Okay. Now, again, I'll be in throughout the week, so we'll talk about some of these trades that we've actually done this week over the next couple of days. And with that said, remember that all investing involves risk. And with that risk, we need to be thinking, is that okay? Are we willing to take that risk? And let that trend play out and that time play out. With that said, this has been the class on the Investing Master Series with how do you invest? How do you trade? And stay tuned for Cameron May coming up next. Take care. Bye-bye.